everyone, and welcome to the Strategic Wealth Strategy Podcast. I'm excited to welcome the host, Alan Porter. Alan, what's going on? The information, again, you provide is just amazing. I get blown away every time I learn new things. I was listening to your podcast with Tom Love today that just dropped on the podcast network and in syndication. And man, everything he says, you say. So it's like, and everyone's afraid in the industry to really tell the truth because of different things, but you're willing to be out there and tell the truth.
Well, I'm very passionate about what I do, what I say. I want to educate people on financial strategies the wealthy have been using against us, the financial institutions. There's no reason we can't do this. We show people how to become their own bank, how to reduce and possibly eliminate both debt and taxes, and provide them more spendable income, not only now, but in the future. But the things that I show people, it's just like I did another podcast for another gentleman last week. He had there's a participating audience there, and 3 of them were doctors. And I got meetings with all those doctors next week. I mean, because every one of them I talked to, when I was setting this meeting up, they said the same thing. Alan, nobody's ever told me this before. And I said, well, when we have our Zoom conference, they're going to learn a lot more. But what I want to bring up today is what's happening right now, and that's the bank failures. So what I've done is I prepared a small PowerPoint presentation. Bear with me one second. So I'll go ahead and I'll start it from the beginning.
Bank failures. Who would have thought that a couple of years ago we'd be talking about this?
Exactly. And, just like back in 2008, I remember I was in the mortgage business in 2008. And these companies, and I lost a ton of money I didn't lose it, but I was going to make a ton of money because of mortgages I had in the pipeline that didn't close because the banks failed. But the problem is that Silicon Valley Bank, Credit Suisse, and First Republic Bank are fueling anxiety for people who want to make sure the money in banks and money market funds are safe. Banks borrowed a record amount from the emergency fund last resort support the Federal Reserve set up just last week. Now think about it. So it's not surprising. People want to know how safe their money is in their insurance policies. And since you must park your money someplace, I'll also explain why you would be hard pressed to find a safer, more advantageous place to put your dollars in good times or bad than a cash value life insurance policy. Not only will it protect you if you live too long, die too soon, it'll protect you if you get sick through many, many benefits that cash value life insurance has, especially whole life policies, which I'm going to feature in this presentation. The dividend-paying whole life policies with the mutual and fraternal companies I work with has survived and even thrived over 160 years. Millions lost their life savings in banks during the Great Depression, but none lost their money in cash value life insurance policies. And nobody's ever been, it's never been documented that anybody lost money in an insurance company. During the Great Depression, over 9,000 banks failed, wiping out life savings of millions of depositors. However, like I said, there's no documented evidence that any life insurance policy holder ever lost money. In fact, these policies were the life raft that saved many people from financial ruin during the Great Depression and the Great Recession and the Great Depression. Since you have access to the cash value in your policy, whenever and for whatever you want, there's no questions asked. That's your money. Having your money safe in a liquid and dividend paying whole life policy doesn't take away from your options. In fact, it gives you even more options, especially when SIHT shit hits the fan. But listen, this is a big thing. And if your policy is from one of a handful of companies that offer these features, you'll get exact same growth even when you've taken money from your policy to use elsewhere. That means you have access to cash to cover an emergency, buy a car, take advantage of an opportunity, and still have your money growing as though you haven't touched it. Now, understand this. Let's say you've got $300,000 in that cash value, and you borrow $50,000 or $100,000. Let's say you borrow $100,000. You're still paid dividends on the $300,000 because these companies are what they call direct non-recognition companies, and they have to pay you dividends on the original amount. Now think about that. There's no other financial product out there that will do that.
No, it's a really a great way to do it. So Alan, before we get to this, I wanted you to explain that more. Give us like a scenario, break that down for us more. Someone puts out, let's say they got 100 grand in something, and then they put it into a cash value life insurance policy. Then basically they borrow that whole $100,000. How long later? And then they can basically, how many years does that take? And then they can take the whole thing out.
Now let's say they've got $300,000 in a CD or savings account or money market fund, okay, which basically making zero, and even if it makes anything, you have to pay taxes on it. Okay, you take that money and put it into a single premium life insurance policy, of $300,000, and let's say 6 months, a year down the road, and you want to put a down payment on a house, and you take out that $100,000. Now let's do this. Let's do a car at $50,000. Okay, it's easier to explain. And you can go to the bank and get that loan and pay that financial institution compound interest, but it's going to compound for them and not yourself. But if you take that $50,000 loan from a cash value for life insurance policy, you can pay yourself back at 0% interest, just like you did with that financial institution. But understand this: if you went to the bank, borrowed that $50,000, paid them back the $10,000 a year for 5 years, you may have a car in 5 years that's worth $30,000. Okay, that money is gone. It's like taxes. When you pay taxes, that money is gone. It's never going to compound for you. It's going to compound for the financial institution. But when you take that money back and take that money from a cash value policy loan in this whole life insurance policy, you pay yourself back 0% interest at $10,000 a year. Not only will you have that car that's now probably worth $30,000 again, just like the same, but you have the $50,000 back in your cash value that continues to compound you forever as long as you have that policy. Plus, since it's a non-direct I can't even talk today, a non-direct dividend paying company, they have to pay you dividends on the original $300,000 in that account, even though you spent $50,000. So you're going to have another $5,000 to $10,000 in that account that keeps compounding for you. It's one of the greatest financial strategies that people have ever come across. That's why I show people how to become their own bank. Everybody pretty much get the drift of this. I hope so, because it's very, very important for people. But here's why insurance companies are so, I don't know, protected. Okay, 3 reasons why. Reason number 1, strict regulation and 4 layers of protection. Life insurance companies are audited regularly by the insurance commission officer, sometimes dozens of states, to ensure they maintain their sufficient reserves to future claims and are on solid financial ground. If a company gets into financial difficulty, the state insurance commissioner's office can take over and run the company in the interest of the policyholders. Historically, a failed insurer's business is then taken over by another company. Most insurance companies are audited regularly by several independent rating companies. And additional policy owners protections may be available on a state-by-state basis. Now, the problem with banks, Neil, they're over leveraged. And as an example, for an insurance company to write, especially a whole life, a mutual company or fraternal company, which caters to their policyholders, not the stockholders. In order for them to write a $100,000 policy on you, they have to have $100,000 in their general account plus an 8% surplus. And companies I use have over 100% surplus. And I think I told you here a couple of weeks ago, I was riding on a plane back from Nashville, a seminar I was at, to Atlanta. And I told her about the things I was talking about. She said, well, my financial planner's never told me anything about this. So I give her my book, Wealth Beyond Taxes. And then I give her my other book on Debt Free for Life. And I said, what's the effective interest cost of your mortgage loans? Because she was head of the mortgage division, I believe. She said, what do you mean? I said, well, that's just it. Nobody understands that. I said, you got a 2.75% interest on a 30-year mortgage. The effective interest cost on that, especially in the first few years, is over 49%. Well, how's that possible, Alan? Well, it doesn't get to the 2.75 until the last couple months of the mortgage. And like this one gentleman I had, he had 7 debts, he had great credit, but his effective interest cost was over 46%. So I asked him, I said, what financial product do you invest in your 401k or anything else? Are you getting a 46% return on your investment? There's nothing. And I said, you need to get out of debt. That's what's killing you, because 46 cents of every dollar that you spend right now goes to compound interest for some financial institution, and that money's gone forever. Like Einstein said, compound interest is the eighth wonder of the world. Those who understand it will benefit from it, and those who don't will pay it. And 99% of people in the United States are paying it. But the list goes on. Reason number 2, sound conservative investments. The companies used by mutual and fraternal professionals invest conservatively to be able to deliver on their promises. Look at this. Most of their portfolio is invested in interest grade fixed income assets. Less than 1 to 2% is invested in U.S. Treasury or government debt. Their bond portfolios are well diversified across many industries and companies, with no investment representing more than 1% of the assets. And due to the financial strength and reserves, they can hold on to many assets for many years, and that may decline in value until they recover. They have never missed, and this is understandable and very, very important, they have never missed paying an annual dividend to policyholders for more than 100 years, including during the Great Depression. I think it's more like, well, for some companies, it's 160 years. And number 3, and I went over this before, the companies are owned by policyholders, not stockholders. So when they make a change, for the policyholder, not to benefit the stockholders. The companies the mutual and fraternal professionals recommend when they design a custom tailored program for you are owned by policyholders, not stockholders, which allows them to focus on the long-term best interests of the policy owners rather than the short-term demands of Wall Street. We've been bombarded with Wall Street propaganda for years. It's just like the other PowerPoints I've done deal with the 401k. What a scam that is, and people don't know it. But it's just things that I want to understand. I want people to understand is to become educated. People, like I said, people need to become educated when it comes to investing money. Even though life insurance is not labeled as an investment, it's a financial vehicle. And do you realize that banks have over $180 billion in that's one of their top tier 1 assets, and it's almost twice as much as real estate. And you go to FDIC.gov and look up every major bank in the United States, and it'll verify what I say. What if there's a way? Let me ask you this question, Neil. What if there's a way to take advantage of our progressive tax system? Turn forever taxable money into never taxable money. Protects you from lawsuits, liens, and judgments. Have your money grow tax deferred and then take it out tax free. Not only that, provides you with long-term care, tax free. Protects you from the taxation of Social Security, the means testing for Medicare Part B, which is going to be in the thousands of dollars per year, and it's going to be even more when taxes go up. Protects you from market loss, all the while giving you the ability to take advantage of those market downturns. Protects you from probate and have your money go to who and where you want when you pass, and not the government say, okay, we're going to take control of this, and we're going to tell you where that money's going to go. Provide you with almost total liquidity of your money to possibly become your own bank instead of filling out a bunch of forms at a bank to secure a loan. Like I said, become your own bank, pay yourself compound interest and not the financial institutions. Would you like to hear about something like that, Neil?
It's amazing. And it's something that literally I took a course in life insurance to be certified in life insurance, health and life. They never talked about any of these things. And even the sales reps that were trying to get me on board to do it never told me about these amazing things that are provided in this product.
Yeah, and nobody does. And like I said, just like the doctor I talked to last night, she said, oh my God, no one's ever told me this. I said, it's all a matter of education. As far as I'm concerned, everything that I've just told everybody should be taught in high school, but it's not. I've got clients that are PhDs in finance and accounting, and they have no idea what I'm talking about. It's just a matter of education. So everybody, if you'd like to hear more about this, please contact me. My number is 910-551-1046. Again, that's 910-551-1046. 1046, or you can reach me at my website. It's strategicwealth0@gmail.com. Again, that is strategicwealth0@gmail.com. Now, Neil, this was just a short PowerPoint presentation, but I hope I got the point across.
No,
Cash value life insurance and life insurance products themselves are absolutely great vehicles that people, they've been educated wrong. They've been told wrong because we're pushed by Wall Street to do everything. Believe that 60-40 stock portfolio. And when you go to, especially when you go into retirement, that just doesn't work. And I've got many clients that when I've told them about sequence of returns risk, longevity risk, the number one fear of retirement is running out of money before you run out of life. And I can show people, I may not make you the richest person in the world, but I'll guarantee you that you'll have a safe, less stressful, happier, and a longer lifetime because you don't have to worry about the ups and downs in the markets. I'm not saying don't get in the market, but what I want to show you is how to have guaranteed income. You may run out of assets, but you'll never run out of business.
And that makes complete sense. And it was interesting, something Tom Love said. Basically, when you say, oh yeah, you won't be taxed after, so you don't want me to be successful. You don't want me to make a lot of money when I'm close to my retirement, and this is the highest amount I'll be taxed.
Yeah.
We don't look at that. We don't look at those things. We see we're saving money now instead of later.
Well, Neil, here's the other thing too, because we have a $31 trillion deficit right now, not to include anything else could be added. And this is a Congressional Budget Office report. If we don't, by 2030, if taxes aren't raised around 66% across the board, we can't even pay the interest on the national debt, and the country will go bankrupt. They're not going to let that happen, so they just print more money.
All right. Well, such great information, Alan. I appreciate it. Another great Strategic Wealth Strategies podcast, guys. Take care.